Hey everyone, welcome back to Corporate Decoder, the place where we dig through the jargon so you don't have to. Today, we're cracking open a freshly amended 10-K filing, and let me tell you, it's got a bit of a plot twist. It's all about Origin Bancorp, a bank you might recognize by its ticker, OBK. Think of this report like a surprise pop quiz a little after you turned in the original exam. Someone wasn't quite sure they aced it the first time. What's got them rushing back to the SEC? Well, it's about internal controls, how well the company manages its own financial reporting. Turns out, there's a material weakness they needed to fess up to concerning how certain employees could move money between deposit accounts. Don't worry, the initial numbers are the same, so your grade isn't affected if that makes any sense, just a small side effect in the grand scheme of things. So this isn't a complete rewrite, just some crucial tweaks. Specifically, they're amending a few key sections. Item 8 about financial statements, and Item 9A about controls and procedures. Plus, a revised consent from their accounting firm. Sounds a bit dry, right? But trust me, we'll find the interesting bits. First up, the financials. Origin's including a revised report from their independent accounting firm, Forvis Mazars, LLP, a change from the original filing. This is a big deal, as it impacts the reliability the SEC and the investors place on the report. Now, this report is dated February 28, 2024, except for the update regarding the material weakness, which gets a new date of February 26, 2025. You can think of it as a "we're still working on it, but the rest is good" kind of situation. To dive into the report, the auditor firm's opinion stated that, in their opinion, the company's internal controls over financial reporting were not effective. Next, Item 9A. This amendment now acknowledges that management concluded their disclosure controls weren't up to snuff as of December 31, 2023. It's that material weakness that's the culprit, and it's why they had to refile this report. And lastly, they're amending Exhibit 23, the consent form from Forvis Mazars. It's basically their formal agreement to be included in the filing and to stand behind their audit opinions. It's like a cosign. Now, Forvis Mazars highlights a few critical audit matters, things that took extra digging and judgment on their part. Chief among these is the Allowance for Credit Losses, or ACL. This is a bank's rainy day fund for bad loans. It requires management to make some pretty subjective calls, like guessing which loans might go south and how much they'd actually lose. It's a tricky business, especially since different assumptions could swing that number wildly. The auditors are calling this out because ACL is based on factors that are not easily quantifiable, like assessing economic conditions. So the auditor took a closer look at how Origin came up with these estimates, making sure they weren't just pulling numbers out of thin air. Forvis Mazars claims to have tested the completeness of the information utilized and the model's computational accuracy, but we still need to evaluate how this ACL affects Origin's financials. A quick note that Forvis Mazars has been Origin's auditor since 2016. It's not a new relationship. So let's peek at those financial statements. Jumping to the balance sheet, the document shows the total assets for the year ended December 31, 2023, was around $9.72 billion compared to $9.68 billion in 2022. Remember, it's a bank. Assets are mostly loans or securities. The interesting thing is the deposit portfolio. Non-interest-bearing deposits plummeted from $2.48 billion to $1.91 billion. On the flip side, and to offset the loss, time deposits jumped from $787 million to $1.41 billion. Basically, their customers yanked their cash and stuck it in higher-yielding accounts. Peeking at the income statement, we see that net income clocked in at $83.8 million compared to $87.7 million the previous year. The rise in interest rates really shows here. Interest income from loans shot up from $286 million to $466 million. That's offset a large jump in interest expense to keep profit relatively stable. Speaking of interest expense, those rose from $51.3 million to $223.8 million. Ouch! Higher interest rates cut both ways. This is something we should keep an eye on next quarter. Lastly, basic earnings per common share were $2.72 compared to $3.29 in the previous year. Diluted earnings per share were $2.71 compared to $3.28 in the previous year. The drops are small, but we'll see how the market reacts. Okay, back to the important amendment details. So, what actually went wrong with these internal controls? Well, it seems the material weakness has to do with how employees were able to manually transfer funds between deposit accounts. These aren't automated transfers set up through apps and websites, these are internal bank initiated transactions. Origin is claiming its team found a weakness in its controls over employees' ability to initiate certain manual transfers. This is definitely something the company needs to improve. The really weird thing is they are also claiming that nothing changed in the company's internal controls over the last quarter, which is contradictory at best and misleading at worst. Scrolling down, we see the equity situation. The 2012 stock incentive plan has been used to give the team stock and incentivize them. The report mentions a stock repurchase program worth up to $50.0 million. This type of action usually indicates a vote of confidence on the company from upper management. So it's odd to see this alongside the material weaknesses, especially since Origin had zero stock repurchases during the year. Focusing on cash flow, there's an interesting interplay with their borrowings. While deposits jumped up over $475 million, we see large outflows from short-term bank advances. There was little to no mention of merger-related expenses in the 2023 annual filing, compared to the previous year where $6.17 million was allocated towards the merger. This suggests that management may be planning a large acquisition in the coming years. Lastly, management is promising to keep following all the commitment and contingency rules set by the big guys, FDIC. They said nothing has changed or are likely to change anytime soon. Nothing exciting. So what to make of all this? Origin Bancorp is basically saying, yeah, we found a pothole in our financial reporting road, but we're patching it up. I have to applaud them for coming out with this amendment. They're required to, but it's good to see that they're working towards fixing internal controls. Forbes Mazars is clearly stating that they found that Origin Bancorp's internal controls are not effective. This is definitely not the report that Origin Bancorp wanted to put out. It's also odd that senior management waited until 2025 to file this report with the changes. I can say with reasonable confidence that the markets will not like this. There will be a lot more eyes on them, and any future filings will need to be perfect. As a large accelerated filer, the numbers for non-interest income have improved substantially in the last 3 years. As more branches and revenue is generated, the firm is looking more promising. The company continues to be consistent in terms of revenue, net income, and operational efficiency. Origin continues to hold itself up as a very strong value in the financial services sector. Ultimately, Origin's still a bank making money and dealing with rising rates. I expect to see Origin handle this mess with grace. The team is excellent and more than capable of addressing the material weakness and implementing a fix in the coming quarters. Thanks for watching. If you enjoyed decoding this report with me, don't forget to hit the like button, drop a comment, and subscribe for more deep dives into the world of corporate filings. Until next time.